So with the iShares Silver Trust, I mean, better known as SLV, experiencing this just massive, almost meme-like volatility here in early 2026. I mean, it crashed 50% from its January highs, but then it suddenly jumps, 5.51% today. What are we actually looking at here?
Yeah, that's the big question right now.
Right. Is this a falling trend? Is it a screaming buy signal? Or is it a dangerous value trap perfectly designed to just wipe out retail traders?
Yep.
So welcome back to the Deep Dive.
Glad to be here.
Today, we are taking a massive stack of sources, right? We've got the latest news, options order flow, macroeconomic reports, and of course, that fierce bull versus bear debate, just to figure out what is actually happening with silver right now, today, April 14th, 2026.
And just to set the table before we jump in, while we are, going to be dissecting institutional technical analysis and digging deep into some of these analyst ratings, this discussion is purely for educational purposes.
Exactly.
We're really just exploring the mechanisms driving the market, but this is absolutely no financial advice.
Right. Purely education, but highly practical education. And hey, if you get value out of us unpacking this madness, do us a favor. Like the video, subscribe to our YouTube channel, and you've got to leave your feedback in the comments. We read them, and we really want to hear your take on this wild price action.
Yeah, we always want to know what you guys are seeing out there.
Exactly.
Yeah.
Okay, let's unpack this, because before we can even attempt to forecast where the price of SLV is going, we have to talk about the sheer scale of where it just came from.
It's been a ride, that's for sure.
It really has. I mean, for one of the world's oldest physical assets, it is currently trading with the chaos of, like, a trendy tech startup.
Yeah, the volatility right now is completely disconnected from silver's historical reputation. I mean, you usually think of precious metals as these sleepy, safe haven assets, right?
Yeah, like you buy it and forget it.
Exactly. You put them in a vault to protect against inflation, and they just slowly, predictably grind along. But what we are seeing now is, well, it's structural instability.
So let's lay out the sheer scope of that instability for you guys. Today's closing price for SLV is $72.04. That's a 5.51% jump in a single trading session. But you have to, zoom out to the 52-week range to really feel the whiplash here.
Oh, absolutely.
Because the 52-week low is $28.88, and the 52-week high is $109.83. And honestly, even that official range masks the true peak.
Right.
Because back in January of this year, we saw this parabolic, almost hysterical surge.
It pushed the intraday price to an all-time high of around $121.
$121.
Which was immediately followed by the floor just completely caving in.
A near 50% crash. The medium-term trend was basically obliterated. And the catalyst in the news for that massive drop was the nomination of a new, highly hawkish Federal Reserve chair, Kevin Warsh.
Right, that was the trigger.
And look, we have to be clear here. Regardless of the politics behind that nomination, we're not taking sides on that. The market just reacted violently to the news itself.
Yeah, the political side isn't what matters to the chart.
Right. I just look at a 50% drop triggered by a single nomination, and it feels like a massive overreaction. Like, why does one person taking the helm at the Fed cause the price of a physical metal to get chopped in half?
Well, if we connect this to the bigger picture, it all really comes down to the gravitational pull of the U.S. dollar and the concept of yield.
Okay, break that down for me.
Sure. When a central bank chair is labeled hawkish, it signals to the entire global financial system that interest rates are going to stay higher for a much longer period. And higher interest rates, they mechanically strengthen the U.S. dollar.
Because foreign investors want to buy U.S. bonds to get those high interest rates? So they actually have to buy dollars first to do it, right?
Precisely. The demand for the dollar just shoots up. Now, precious metals like silver are globally priced in U.S. dollars. So when the dollar gets stronger, silver becomes mathematically more expensive for buyers who are holding euros, yen, or yuan.
Ah, so that just suppresses the global physical demand.
Exactly. But there is a second, even more punishing mechanism at play here. Silver is a rock. It does not yield a dividend. It does not pay you quarterly interest.
It literally just sits in the dark.
Right. It just sits there. So when the risk-free rate of return, I mean, the interest you can get just by holding a government bond goes up thanks to hawkish policy, large institutional capital allocators, they look at their portfolios.
And they want that guaranteed return.
Yeah. They ask themselves, why am I holding a volatile, zero-yield metal when I can get a guaranteed 5% or 6% yield in bonds? So capital aggressively flows out of metals and into debt. That capital flight is the core mechanism that crushed SLV from $121 down to the 60s.
Man, that structural shift makes total sense, but it puts the retail investor in such a bizarre position. Because my natural instinct, and I guarantee the instinct of anyone listening who sees an ETF crash by 50%,
Yeah.
is to look for fundamental stability.
You want to check the math?
Exactly. If I see a tech company drop 50%, I want to open the hood. I want to check the quarterly income statement. I want to look at the balance sheet, assess the cash flow, and see if the PE ratio makes it a value buy. But when I try to do that with SLV, the sources just give me like blank stares. I can't find a corporate earnings report anywhere.
Because you are looking for a corporation where one simply does not exist.
Right.
SLV is structured as a physical grantor trust. It is not a business. There is no CEO making strategic decisions, no product launches, no quarterly earnings calls, and zero cash flow.
No cash flow at all.
None. The trust charges an expense ratio of 0.50% simply to cover the cost of administration and renting the physical space in the vaults.
So it really is just a massive pile of metal sitting in a room somewhere.
That is the entirety of the asset. The valuation of the ETF is derived purely from the spot price of the physical silver bullion held by the custodian. They just create or destroy shares based entirely on whether they are adding physical silver to the vault or taking it out.
But wait, if I can't look at a balance sheet or calculate a price-to-earnings ratio, how on earth do you know if this asset is actually undervalued right now, or if retail traders are just getting lured into a dangerous value trap?
It's a tricky debate.
Because our sources are showing a wildly polarized debate. You have one camp of analysts screaming that SLV is dirt cheap, and another camp warning that it's a trap inflated by meme stock speculation. How do institutions value this thing if there are no financials to read?
Well, when you can't measure corporate earnings, you have to measure macroeconomic supply and demand for the raw commodity itself. The undervalued argument is heavily anchored in the physical deficit.
Mining deficit, right?
Yeah. Right now, the world is facing a projected 67 million ounce global silver deficit. We are currently in the 6th consecutive year where the global economy is consuming more physical silver than the mining industry is actually pulling out of the ground.
Wow. 6 years of burning through the reserves.
And those analysts argue that the massive structural deficit has still not been fully priced into the ETF. They look at the historical ratio between the price of gold and the price of silver, and mathematically, silver is lagging far behind where it should be given the scarcity.
Okay, so that's the undervalued side.
Yeah.
But the value trap argument completely ignores the vault, right? They look at human psychology.
Yes, exactly.
They point to the chart and highlight what they call exhaustion gaps.
Right, the exhaustion gaps.
Break that down for me. What is an exhaustion gap in this specific context?
Okay, imagine a marathon runner sprinting the final mile of a race. They are moving incredibly fast, but they are burning the absolute last of their energy reserves. On a stock chart, an exhaustion gap happens when buyers push the price up so violently overnight that the price gaps up on the open.
Meaning it opens significantly higher than it closed the previous day.
Yeah, leaving a literal blank space on the chart. But there is no sustained buying power left to keep it there. The buyers are simply exhausted. So the bears look at SLV spike to $121, they see those massive gaps, and they argue that the current $72 price point is still artificially inflated by leftover retail mania, not actual physical demand.
Here's where it gets really interesting. Because with traditional corporate valuation metrics completely off the table and the fundamental supply and demand debate basically deadlocked, we really have to pivot to the technical tape.
We have to look at the math.
Exactly. How the market is mathematically pricing this ETF minute by minute. And looking at the reports, the technical indicators are just a complete mess. It is a massive tug of war.
The landscape is deeply conflicted right now. There is no clear consensus on the tape.
So let's try to translate this mess of lines for everyone. On the broader rating side, SLV was actually upgraded in early April. Analysts moved it from a sell to a hold or accumulate status.
Which is a positive shift.
Yeah, but when you look at the moving averages, which traders use to figure out the baseline trend, they are stacked on top of each other like a narrowing hallway.
The price is essentially trapped in a squeeze.
Exactly. Right. The short-term 5-day moving average is sitting at $71.76, which means the current price of $72.04 is triggering a short-term buy signal.
Right.
But below that, the 20-day average is $69.48, acting as a floor of support. Then you have the critical 50-day pivot at $67.90. But way down below, the long-term 200-day average is at $69.17. The current price is wedged right into this cluster.
It's very tight. And you've got resistance above at the recent high of $73.84 and a major psychological ceiling right at $80.
And if that floor breaks,
The technicals show the next major safety net is way down at $63.40, which is a key Fibonacci level. But, the moving averages only tell you where the price has been.
Or they're lagging.
Exactly.
Yeah.
The momentum oscillators are supposed to tell you where the energy is going, and they are flashing massive contradictions right now.
That is the part that is making my head spin. I'm looking at the RSI, the Relative Strength Index, and it is highly elevated at 71.06.
Which is high.
Yeah, and for anyone unfamiliar, you can think of the RSI like the tachometer on your car. It measures how hard the engine is revving. Anything over 70 means the engine is redlining. The asset is overbought and statistically due for a pullback before it overheats.
But the MACD is telling a completely different story.
Yes, the MACD indicator just triggered a buy signal. Its value is sitting at 1.23. If the RSI is the tachometer saying the engine is redlining, the MACD is the actual gas pedal, and it's saying the momentum is accelerating upward.
It's a complete paradox.
How can an asset be completely overbought and triggering a buy signal at the exact same time? If the mathematical indicators are fighting each other like this, aren't retail traders just gambling?
What's fascinating here is how institutional money, the smart money, behaves when faced with these exact chaotic contradictions. They don't try to guess which indicator is right.
They don't.
No, they build a structure to survive either outcome. And we can see this clearly when we look at the order flow in the options market.
So who is buying what?
Right now, the options volume is aggressively, overwhelmingly bullish. The data shows between 70% and 82% of the daily volume is flowing into call options.
Wow, that's huge.
Yeah, these are contracts giving the buyer the right to purchase SLV at higher prices. They are heavily betting the price will go up.
That sounds like they're ignoring the overbought RSI entirely and just, mashing the gas pedal.
It looks that way on the surface. But you have to look at where the remaining percentage of the money is going. Alongside that massive call volume, there is a mountain of institutional put interest parked heavily right at the $67 strike price.
Okay, a put option gives the buyer the right to sell the asset at a specific price, regardless of how low the market crashes, right?
Exactly.
Wait, but aren't put options just bets that the price will crash? If they're buying calls to go up and puts to go down, aren't they just canceling out their own trades?
Not if you already own the underlying asset. They aren't betting on a crash. They are buying an insurance policy.
I see.
Think of that $67 put wall like the crumple zone engineered into a Formula One race car. The driver is slamming the gas pedal, buying those call options to capture the upside momentum, but they know they are driving at dangerous speeds.
So if they crash?
If that overbought RSI signal suddenly takes control and the market violently corrects, that $67 put option acts as a mechanical wall. No matter how low the price drops, they are guaranteed the right to exit at $67. It strictly limits their downside risk.
Man, so they are participating in the rally, but they've already locked the exit door behind them, while the retail trader just buys the stock at $72, hopes for the best, and ends up holding the bag if it drops to $60.
That is the defining difference in how institutions navigate these mixed signals.
Okay, so having established this intense, highly hedged technical battleground, let's step back and examine the underlying macro drivers, because ultimately moving averages and options contracts are just reflections of buying and selling pressure. We need to look at what is actually causing that pressure.
The fundamentals behind the tape.
Right. And let's start with the risks, because the volatility numbers in these reports are frankly terrifying for a physical commodity. The ATR, the average true range, is fluctuating between 2.94 and 3.55. What does that actually mean for the money in my account?
It means the asset is routinely experiencing daily price swings of around 4.5%.
4.5% a day.
Yes. For an ETF that tracks a physical metal, that is seismic. A 4.5% swing in a single day is enough to trigger stop-loss orders and shake out almost any casual investor who isn't properly hedged.
And that kind of wild movement brings massive liquidity risks, doesn't it? Because SLV isn't the only way people trade silver. There are leveraged products out there.
That is a critical hidden risk. There are leveraged ETF that promise to deliver 2 or 3 times the daily return of silver. But to do that, they have to use extreme amounts of financial derivatives. When SLV drops 4.5% in a day, a triple leveraged product drops nearly 14%.
Ouch.
Yeah. And to prevent their funds from collapsing, the managers of those leveraged products have to aggressively sell off their underlying assets before the end of the trading day just to rebalance their books. That massive forced selling spills directly over into SLV, accelerating the crash. It creates a self-fulfilling downward spiral.
It's just a cascading failure. But to be fair to the other side of the debate, The bull case driving this 5.51% jump today is incredibly compelling. We mentioned the 6 consecutive years of a global supply deficit earlier, but we didn't talk about why that deficit
The
exists.
demand side of the equation.
Right. It is not just that people are hoarding silver coins. The industrial demand from the solar panel industry and the electric vehicle sector is exploding. And the key word in the analyst reports is inelastic.
Inelastic demand is the holy grail for a commodity bull.
Right, because you cannot build a modern, high-efficiency solar panel without silver paste. The metal is uniquely conductive. If the price of silver goes from $20 to $70, the solar manufacturer can't just decide to use copper instead because the panel would oxidize and lose its efficiency.
They have no choice.
Exactly.
Yeah.
They have to buy the silver regardless of the price, or they have to stop making solar panels entirely. Add in the electronics inside every new electric vehicle, plus the traditional safe haven buying triggered by the ongoing geopolitical tensions in the Middle East, and you have an industrial machine that is forced to consume a shrinking pile of metal.
That is the immovable object of the bull case. But then you have the unstoppable force of the bear case.
The macro headwinds.
Yeah, we already discussed the hawkish Fed policy under Kevin Warsh and the strong U.S. dollar. But veteran analysts look at this recent crash cluster, that parabolic spike to $121 and the violent 50% drop back down, and they see a terrifying historical parallel. They're comparing this to the notorious 1980 silver bubble.
Wait, like the Hunt brothers?
Exactly the same dynamic. In 1980, two wealthy brothers tried to corner the global silver market using massive amounts of borrowed money, driving the price up to record highs.
Right. They basically bought it all.
Yep. But the regulator stepped in, changed the rules on how much borrowed money could be used, and the bubble popped, resulting in a devastating crash. Bears looking at SLV today argue that the January spike to $121 wasn't driven by solar panel demand at all.
It was driven by leverage.
Right, modern retail leverage. And just like in 1980, when the leverage gets squeezed, the crash is spectacular. That is why the sentiment tracker right now is perfectly deadlocked.
A 50-50 split.
Exactly, 50% bullish based on the green energy industrial reality, and 50% neutral or bearish based on those macroeconomic and historical fears.
So what does this all mean? I mean, when you have a perfectly split 50-50 market sentiment, violent 4.5% daily swings, a fundamental supply deficit fighting a hawkish central bank, and an asset that crashes 50% only to jump 5.5% in a single afternoon, how does an individual investor even navigate this environment?
It means accepting that the market is in a raw phase of highly emotional price discovery. Retail traders consistently get trapped in these exact conditions because they let the emotion of the chart dictate their actions, rather than waiting for the technical dust to settle.
And get caught up in the FOMO.
Totally. They see the price running up 5% in a single day, they feel the fear of missing out, and they buy in right at that $73 resistance ceiling. The very next day, the asset swings 4.5% downward, and they panic sell for a loss.
So they just get chopped up.
Right. The only way to survive a market this volatile is to behave like the institutions. You have to strictly define your risk before you enter the trade, whether that is through options like the $67 put wall or by sizing your position so small that a 5% drop doesn't keep you awake at night.
So as we look to synthesize all these conflicting sources and really wrap this up, let's summarize the dual timelines here, because the short-term reality and the long-term outlook are telling two completely different stories.
Very different.
Yeah. In the short term, over the next few days and weeks, our institutional sources suggest we should expect choppy, brutal consolidation. The price is going to be bouncing around in that narrowing hallway between the $56 support area and the $73 resistance area. The market is still aggressively trying to digest the realities of the new Fed policy and figure out where the floor actually is.
The short term is entirely about capital preservation right now.
Right.
But when you look at the medium to long-term outlook from the major analysts, the tone shifts dramatically. Looking toward the end of 2026 and beyond, the price targets are sitting firmly between $80 and $100 or more.
That's a massive target.
It is. They're placing a massive bet that the inelastic green energy demand from the solar and EV sectors, combined with that 67 million ounce physical deficit, will eventually overwhelm the macroeconomic headwinds of a strong dollar.
And that is the crucial takeaway for you listening today. Whether you are a short-term day trader, meticulously tracking that 5-day moving average, or a long-term investor holding SLV because you fundamentally believe in the global transition to electric vehicles, this is not a set-it-and-forget-it asset.
Definitely not.
You cannot just blindly buy it and ignore the chart. You need a concrete, mathematically defined strategy to survive these daily 4.5% swings without getting shaken out or caught at the top of a value trap.
This raises an important question, though, one to keep in the back of your mind as you watch this tug of war unfold. We've talked extensively about SLV being a paper ETF backed by physical silver in a vault. And we've talked about how solar and EV demand is fundamentally inelastic.
Right.
If that industrial demand is truly as relentless as the bulls claim, and the global deficit continues to widen year after year, how long can central bank interest rate hikes realistically suppress the paper price of the ETF before the physical vaults simply run empty?
Wow. That is a fascinating and somewhat terrifying thought to end on. Because if the solar manufacturers literally buy up the last of the physical metal, it won't matter what the MCD or the RSI says. A paper contract is useless if the vault is empty.
Exactly.
Thank you all for joining us on this deep dive into the absolute madness of SLV. We really want to hear your read on this, so drop a comment below with your own predictions. Is the inelastic demand going to drive SLV past that $100 mark by the end of 2026? Or is the hawkish Fed policy going to crush it right back down into the $20?
Let us know.
Yeah, let us know what you think in the comments. And remember to like this video and subscribe to the channel so you never miss a deep dive. Until next time, stay curious.